After receiving quite a few requests for a new YouTube video, I am putting one up today that has to do with reading the volume and looking at bid asks and understanding how spoofing can impact price movement, as well as how large orders and size in general impact price movement. I don't do fancy YouTube videos. I don't put myself on them. I just prefer to put up my work screen and my depth of market and show you guys trades that I've actually made and walk you through the ideas just to give you the concept. If you are interested, my site is nobsdaytrading.com. If you go to education, I have a basic course that covers the basics of order flow. It's not basic in terms of explaining what futures are or trading on margin or anything like that. It's, it assumes you already know that and covers more of the ideas behind order flow, volume, the depth of market, also known as the ladder or the DOM or the order book. So I have a basic course that covers that, an intermediate course that builds on the basic, and then I do have a live room that I run several times a year for 2 weeks at a time. That's under the live trading tab. I have a futures markets webinar that focuses on treasury futures and stock index futures. And I also offer a stock market course now. I've been trading stocks quite a bit since the zero commission structure was introduced several years ago. Stocks have become a very good trade since then. So this is worth checking out if you have the capital to day trade stocks and also can take advantage of the zero commission structure. In this last webinar that I ran the first 2 weeks of October, I traded futures and stocks a little bit. I wanted to give the class an all-around view on my approach. So yeah, if you're interested, come to my site. You can contact me through my contact page. And then, as everybody says, please like and subscribe. And also, I have a Twitter account. There's a button there if you want to go subscribe to my Twitter. I don't post on there very often, but I do sometimes. So I'm going to try to keep this video short and sweet and to the point, give you the information without a lot of excessive talk. This is from a document that I read the first day of the webinars. It's pretty simple, but it is something that I wanted to share on this video. The idea being, why do you think that it is that you find yourself on the wrong side so often? The answer being, it's a poker game and you're being outplayed. The idea of player versus player is appealing in theory because it means you just have to learn to play better than the next guy. The problem arises when you realize your opponent is a major market-making firm with billions at its disposal. I'm going to get into that in this video. The difference between making a lot of money on a trade and making nothing is sometimes entirely luck. I can't get paid if big players aren't pushing the market in my direction. It's that simple. What I mean by that is market-making firms are working size, and they trade against each other as well, right? So if a lot of market making firms aren't involved in moving a lot of size, which requires of course a lot of money, that's when you tend to see the markets not trend so much. There's not a lot of continuation. There aren't big pushes in one direction. So I might make a read, for example, that a market will break a high or a low, and I'll get in the trade, and then the market does break the high, let's say. But if it's slow, and if bigger firms aren't on board or aren't trying to really push price higher, I'm simply not going to get paid. So I can't push the market higher with my volume. I need additional volume coming in after I get in to push price higher. That's what I'm trying to anticipate. So if I take a trade, the market goes to new highs, but the bigger players don't come in, there's not going to be any follow through. It's just going to stop, and I'm only going to end up with a small win or a small loss or a break even. So the read itself about anticipating, let's say, a market breaking a high might be a good read, and I have that correct, but how much I make on that trade is going to be dependent upon the size that comes in and pushes in my direction. Okay, that's what I mean by this statement right here. In general, the main obstacles for most people are: a person does not understand the game, does not understand the idea of anticipating market orders, does not have the time to learn, does not have the capital to learn, doesn't have the discipline to react in the proper manner, i.e. holds on to losses for too long, does not learn to handle risk, or the personality isn't conducive to speculating. Um, the focus of this video is going to be this first two, which is most people don't understand the game at the core, meaning they don't understand game theory or how size influences price, and they don't understand the idea of anticipating market orders. So let's just jump right into it. As usual, I have to give the disclaimer that this video is for educational purposes only. There's no recommendation to buy or sell anything. There never is. Also, there's never any recommendations in my webinars. It's simply me showing how I trade and trying to provide information and education. Okay, so, it's not scripture here, and there are no guarantees in this business, but you will see how this is useful in at least understanding price movement. So the main topic today is going to be the idea of spoofing. The reason this is important is because spoofing does influence price. So if I notice there's a decent amount of spoofing taking place, I will adjust my strategy around that. If there's not a lot of spoofing taking place and a lot of volume is trading and maybe pushing in one direction, then that's a different type of context, a different type of scenario. And I mention context in all my videos many times because it is very important. So despite what the regulatory agencies would have you believe, spoofing takes place every day. Even though they catch people and they find people, you still see it every single day. It does influence price, and you want to be aware of it. This is an excellent example of that. Now, I ended up taking a short trade. This is from the current webinar, or the one that I just ran. And I'm not going to get into all the reasons why I decided to short this price. But one of the reasons is that there was some spoofing happening, and I was anticipating that some of these bids were spoof orders. And the trick here is, as spoofs pull away, if the order cancels, it tends to act as a magnet to attract orders in that direction. So I was looking at it from the sell side, and I'm expecting that some of these bids will drop away, and as they do, price will move lower, and I get paid. And this goes back to the concept of one has to anticipate market orders. So what that means is when I get short, the only reason I'm getting short at 3.5, okay, and by the way, this is my emergency stop loss, just in case something happens. The only reason I get short is because I'm thinking that market sell orders are going to hit these bids. So sellers will hit this bid, and then this bid, and this bid, and this bid, and price will move lower. And that's how I get paid. The mistake that many people make is waiting for a market to move too far in one direction, and then they chase, and they end up entering a trade exactly where the move stops and then turns and reverses. Okay, so you have to try to anticipate things before they're going to happen based on the context and the scenario. So this is a really crystal clear of how this works and how market making firms and bigger players will maneuver. So it takes a little bit for this to play out. In other words, it takes a couple minutes. So I'm just going to show you what happens when it starts dropping. It bounced around just a little bit. It only moved 2 ticks against me. Came back to my price. And sellers start hitting the bids. Now here's the important part of this video and what I want to try to explain. If you look at the bids, you'll see that there's 29.20 on the bid at 2.5. That's what 2.5 is. These are Treasury futures, by the way. The 10-year, the 30-year, the 5-year, and the Ultra Bond. This is the ES, and this is the NASDAQ. So in the 10-year, there's 2,900 on the bid, 29.20 at 2.5. There's 27.26 at 2, 26.85 at 1.5, 22.71 at 1. I'm in this trade, and what I'm expecting is that some of this is going to trade on the way down, but a lot of it is not. So I will be looking for these bids to drop away, but volume, the total volume won't actually trade. So here's what I mean by that. You can see that the market trades there at 3, the 10-year does. Trades back and forth just a little bit. Now, do you see that? that 2,900 drops away to 1,400. So 1,500 contracts cancel and pull, as I call stacking and pulling. So that's pulling away. Stacking would be if there were 1,400 and then it goes to 2,900. The buyers would be stacking buy-side limit orders on top of it. So they pull a significant amount of the bid, and then it will trade at that price, a decent amount, like 1,200 or 1,700, excuse me. So 1,800 plus, this is the total amount that trades. All right, and I discussed this in the order flow basics video that I have on YouTube. So if you don't understand what all of this is, I would recommend you watch that video. Essentially, the number in red is the amount that trades as sellers are trading into the bid. And once price flips from bid to offer, the blue is the amount that hits back in as the offer is there. And then obviously it happens so fast you can't see it sometimes. But that's what this is. And then, of course, the two combined is the total amount that's currently trading at that price. So notice how there's 2,300 on the bid at 2. Now watch what happens. When it trades, and it happens, of course, too fast for you to see it, only 705 trade there. So what that means is there's 2,300 on the bid, okay? And 1,600 contracts cancel. As those 1,600 contracts cancel, sellers go for the remaining 700 that's there, and they hit it. So they trade 705 contracts at 2. Now, same thing's going to happen at 1/2. Let me back it up so you can see. 2293 contracts showing at 2, but when it trades, only going to trade 705. And then you can see there's 2,428 contracts at 1/2. But that's going to cancel away, and they're not going to trade very many there either. So watch this. Boom, right there. They go from bid to offer. That bid starts to drop away. 1,200 trade there. Decent amount still based on it, but not 2,000. And then the next price, which was also above 2,000, if you look at it, drops away all the way to 465. With nothing currently trading. So this price goes from 2,000 plus on the bid to only 400 bid. Okay, so as that happens, that acts as a magnet for sell orders to hit the weaker bids. That's why it takes place. Sellers go for these bids. Okay, and you can see there's pretty much constant stacking and pulling of some amount, but when it really matters, particularly in the 10-year, is when there are large amounts that drop away to very small amounts. So the same thing happened there. Let me just show you again. You can see how there's currently 1,900 bid at 1/2 here, but when the market trades lower, drops all the way down, and only 465 actually trade there. See that? So as long as that's happening, that's a good sign for me. I want to hold the trade. With this particular situation, I was anticipating probably getting out of the trade around this area anyway, for several reasons. So I give it a little bit of room to work, and then do take the trade off in this area. I'll just fast forward through that to kind of show you. They trade down a little bit farther, and then I end up getting out here at 1/2 right there, and then it bounced up another tick past that. And reason being, like, treasuries tend to be a little bit more range bound than the stock indexes on average. So because that's the case in the scenario like this, I'm not typically looking for that to become a 10 or 12 tick win. So the point to it, though, is I'm anticipating that exact activity when I put the trade on several minutes prior. So as a trader, that's what you're trying to do. You're trying to anticipate certain situations developing. Not every situation is like this. Sometimes there's not that much spoofing. Sometimes there's more volume trading, so on and so forth. And I'll adapt based on what I think's happening. But this is why price will spike like that. So a person who's just looking at a chart, they'll see a green bar, and the green bar will go higher and higher, and then the person finally decides to buy, and about the time the person buys, suddenly there's a red bar going in his face, and the market's moving in his face, and he doesn't understand why. Well, frequently this is why. It's because he doesn't realize that there are bids and offers in the first place, because he doesn't even understand what's happening, that there is an order book. Or if he does know that there's an order book, he's not looking at it. He doesn't understand game theory, spoofing, and size influencing price. And secondly, yeah, he doesn't realize that, that kind of spoofing and then canceling attracts price the other way, or that can even happen. And that's why you get quicker moves in one direction. It's usually because there's not a lot on the bid or ask, and it doesn't take much volume to move through several prices in a matter of seconds. So I did also have losing trades in treasuries too. I don't want to make this out like I'm cherry picking just a winning trade. It's just that this happened to be one of the better examples of the spoof orders canceling out and price dropping away as a result of that. Following up on this idea that I mentioned earlier of the difference between making a lot of money and maybe making nothing is sometimes entirely luck, and not being able to get paid if the bigger players don't push the market in my direction, this is a great example of that. I didn't take a trade here, but I'll explain the thought process and the reasoning, because this is just a great example that I caught on video. And I wouldn't take a short trade here for this reason. So if I already know that the ES and the NASDAQ have been pretty choppy, usually in that scenario, in that context, especially if we're an hour in, which we were here, is 10:24 a.m., right? So the market's been open about an hour. Breakouts aren't that reliable. It can happen. There can be a few orders that get triggered off, stop losses and whatnot, but often there's quite a bit of volume that'll trade, and then the market will just bounce back into the area, the previous area. And this is a good example of that. So you see the ES is at 55, anticipating that it might break lows here. Sure, okay, they might break lows, and in fact might be okay for a short-term short play. But as it breaks lower, the only way that short trades are going to get paid a decent amount is if a good amount of size comes in and sellers just keep hammering the bids. But frequently what tends to happen in a situation like this is, market making firms will short into the low, but as soon as the market breaks lows, they immediately start working buy-side orders to cover their short position. And that's why you see the stock indexes often just go back and forth, because bigger firms will work some offers, then they'll start pushing lower, cancel some bids, pulls the market lower, and then put their bids out and cover. And then they reverse, they work some bids, they get filled on the bids, they cancel their offers, they push the market higher, and then they cover. And that's the idea. And of course, within that, there are plenty of retail traders and prop firms trading 1 lots, 5 lots, 10 lots, etc. And that they all feed off each other to a degree. But a lot of the back and forth is dictated by the bigger firms that are moving size. So this is a good example of that. It breaks lower, but not fast and not quick. And there's not a lot of follow through on it. And I'm just going to fast forward here and show you. They trade back down to that area, then they trade back up, and then back above 55, right? So this is where retail traders can fall into the trap of they chase the sell side trade once it goes through 55, and then they get hung in a trade that moves against them, and they don't understand why, and then they allow, rather than taking a break even maybe, or a small loss, or the small win when they just won't go, they watch it roll back and possibly move against them 5 or 6 points, which is just not the right play when the context is like this. So if it's already choppy, and I already know it's choppy, and I know it's unlikely that the S&P is suddenly going to break 8-9 points, then yes, maybe I do take a short trade there quickly, just to try it. But if it doesn't go, I get out very quickly. You know, small profit, small loss, break even, whatever. I don't let it roll back on me. And it makes a big difference in the long run because it keeps you out of trouble trades. So being able, again, to anticipate whether it's likely that there will be a fast, quick run or whether it's likely to be choppy can help you decide whether you want to be involved or not be involved. And if you are involved, how to manage the trade in a way that you don't just watch it keep grinding against you if you're on the wrong side. Now I'm going to finish the video by showing you a stock trade that does not work, something that educators don't normally do, show you losing trades. But it's an excellent example of what I would call market manipulation, certainly how spoofing influences price, and also the reason why I watch this stuff. So watching price action and volume, and also just knowing your product and how it tends to move, can help in identifying whether I feel I'm on the right side or on the wrong side of a trade. And I know almost instantly that I'm on the wrong side of this trade. I'm not going to show what stock it is because I tend to keep this only to webinar participants. Stock trading is a little bit more specialized. The liquidity is different than in Treasury futures, for example. But nevertheless, I'm going to throw this out there for the world to see so that everybody who watches this knows what they're up against if they decide to play this game called day trading. In this scenario, the indexes had been moving higher. This stock had been moving higher. I tend to try fade trades. I'm fairly good at them. In other words, going against the trend. I can call the areas fairly well where there'll be a pullback slash retracement slash bounce, whatever you want to call it. So when the market stops and goes the other way, right? Even if I get run over once or twice, I'm pretty good at about eventually catching the turning point and then getting my money back plus some more. So I can make the argument that trying this fade right here, maybe not the best trade given the overall context at that moment in time because the indexes were pretty strong. Nevertheless, this is a great illustration of what I'm talking about in this video. What you'll see is that there's a bid of 19,582 shares. There's an offer of 583,765 shares. So relatively speaking, the bid is obviously very weak compared to the offer. Here's where you have to understand that spoofing happens and market makers and bigger players play games with bids and offers and the way they trade in an attempt to kind of influence price. So you'll see that I'm about to click in and sell 10,900 shares. You'll see it roll across the time and sales along with some other orders. You will see that 124,123 have traded total. This is the total number of shares that have traded at this price today. That's going to go above 160. And once that happens, this bid is going to not go away, but instead become 300,000 plus shares. So I click, other people click. See that? All these shares trade, you miss them, they already passed by. It goes from 123 to 165. So about 42,000 shares trade there at that moment. And as soon as those shares trade, that bid pumps up to 300,000 plus. And that 550,000 that was on the offer drops to 280. They stack at 6, they pull at 7. Now you'll see that the total amount that's traded at 7 so far is 2,300 shares total. This offer is going to drop way away, and that's going to go to 7,000, and then it's going to go 7.8. So pretty much the entire offer of 550,000 that was their total, and that's a combination of multiple orders, right? All disappears. You see there it drops down to 68, 300 shares trade. And then they're going to trade about 5,000, and it's going to flip. 7's going to go from 7 offer to 7 bid. and there they go. You see that? So even though at one point there were 550,000 shares showing on the offer, ultimately it only trades another 5,000 and then goes bid. And as that happens, this offer falls away, and you're going to see that that offer that's above 300,000, the majority of that's going to cancel out, and very little is going to trade there. And there it goes, 1,300 shares. So 300,000 is on the offer, but then all of it canceled out except 1,300 shares. And then someone buys that 1,300, and now they bid it up. You got 490 on the bid at 8. Clearly, when this happened and they get through me, and as soon as I got short, I knew I was on the wrong side. Sometimes I do have to give it a minute. Frankly, should have been hitting out at 8 right there and saved myself a penny. Same thing's going to happen at 9. The offer is going to drop away. I know I'm on the wrong side. I know that I've been suckered into selling at a bad price. I'm sitting for just a second, hoping they might let me back out at 8 again. But no one's hitting it, as you see. And there goes the offer. I see the offer disappear. I don't hesitate. I click out. The majority of that's my 10,900, obviously, since 11,500 is a total. And I exit the trade for a loss, which is the right play. And the point to this is by watching the order book and the volume trading and the price action, meaning how it's ebbing back and forth. Is there follow through? Is there chop? So on and so forth. Helps me anticipate what's probably going to happen next. And sometimes in a situation like this, I'll actually turn around and go long because clearly the buyers are pushing higher through me. But sometimes what happens is they'll push past a point like that, and then they'll start working or offers and getting their fill. So if I reverse too late, I'll end up buying right where they sell out of 30, 40, 50,000 shares, and then it'll pull back a couple pennies. So yeah. That is the way it works. Not all the time. Again, there are times when there's heavier volume in this stock and other stocks in the futures, and you don't have quite as much spoofing taking place and what I would call manipulation. But this was one of those moments where it was very obvious that the buyers wanted to buy at 5 and 6. And they sat there waiting to get their fills, and then as soon as they get their fills, they stack the bid and cancel their offers at 7. And that, of course, attracts buyers, again, like a magnet, and then it pushes 7, 8, 9. So I hope all of you find that helpful in some way, and it gives you some insight into market-making tactics and how size, or the lack thereof, influences price. And if you have any questions about my material, please feel free to go to my site and go to the contact, send me a contact. And thanks for watching, and thanks for subscribing.